Most retirees don't realize this until it's too late. But the biggest threat to your retirement isn't the market, inflation, or even running out of money. It's taxes. Not the taxes you pay while working, the taxes you pay after you stop. Because here's the uncomfortable truth. You can save diligently for 30 or 40 years, do everything right, and still lose hundreds of thousands of dollars in retirement simply because you withdraw your money in the wrong order. And the worst part, almost everyone follows the same advice, and almost everyone gets hurt by it. Today, I'm going to show you a retiree withdrawal approach that flips conventional wisdom on its head, and why, for the right retiree, it can dramatically reduce lifetime taxes, protect health care subsidies, and give you more freedom in your early retirement years. This is not a loophole. It's not risky, and it's not talked about enough. Most retirement advice tells you the same thing. Spend your taxable money first. Then your pre-tax money, like a 401k or IRA, and save your Roth for last. It sounds logical. It feels safe. And on the surface, it looks tax efficient. But for many retirees, especially those retiring before Medicare, this advice quietly creates a tax disaster later. Let's talk about why. Imagine a retired couple in their mid-50 seconds or early 60 seconds. They're done working. They want to spend about $100,000 a year. They have a large 401k balance, maybe over $1 million. And they also have a taxable brokerage account with money that's mostly already been taxed. This is a very common situation. Now, if they follow the standard advice and live off the brokerage account first, something interesting happens. At first, life feels great. Taxes are low. Healthcare premiums are cheap. Income looks clean on paper. But quietly, year after year, something dangerous is building in the background. The pre-tax accounts are untouched. They continue growing. And the tax bill is being postponed, not eliminated. Fast forward 10 or 15 years. Now, Social Security kicks in. Required minimum distributions begin. Tax brackets shrink. Medicare premiums increase. And suddenly, income that once felt controlled becomes forced. That's when retirees are shocked. They didn't change their lifestyle. They didn't splurge. They didn't make reckless choices. Yet their taxes explode. This is when many retirees say, I wish someone had told me this earlier. Now here's where the strategy changes. Instead of avoiding your pre-tax accounts early in retirement, the idea is to use them intentionally while tax rates are low, while income is flexible, and while healthcare subsidies are still available. In other words, you don't wait for the IRS to force withdrawals later at higher rates. You choose to withdraw earlier at lower rates. This changes everything. Think about the early retirement years before Medicare, before Social Security, before RMDs. These are the only years where you have near total control over your taxable income. That window doesn't last forever. Using that window wisely can mean the difference between a calm retirement and decades of tax stress. Here's how the approach works in real life. Instead of spending only from taxable accounts, a retiree intentionally withdraws a controlled amount from their 401k each year, just enough to fill the lowest tax brackets. Not too much, not recklessly, just strategically. They use the standard deduction. They fill the 10% bracket. They may dip slightly into the 12% bracket. The taxes paid are modest, often far lower than what will be forced later. Then, the remaining spending needs come from taxable savings that already have a high-cost basis, meaning very little tax is triggered. The result? Income stays low enough to preserve healthcare subsidies. Pre-tax balances shrink early instead of ballooning. Future required distributions are smaller, and total lifetime taxes drop sometimes dramatically. This is where many people get confused. They say, but shouldn't I avoid paying taxes as long as possible? That sounds smart until you realize delayed taxes often become higher taxes. Avoiding tax today doesn't mean avoiding tax forever. It often means concentrating taxes into fewer years when rates are worse and options are fewer. One of the most overlooked dangers in retirement is something called the tax pileup. Large pre-tax balances plus Social Security plus required distributions plus Medicare surcharges. that combination can push retirees into brackets they never expected to see again. And once you're there, there's no easy escape. Now, there's another benefit to this approach that doesn't show up clearly in spreadsheets: confidence. When retirees reduce future tax uncertainty early, they sleep better. They don't fear letters from Medicare. They don't fear RMD age. They don't fear being pushed into decisions under pressure. They've already handled the problem while they had control. This is also where many people ask about Roth conversions. And yes, Roth conversions can be powerful, but they're not always the best first move. Why? Because conversions create taxable income, and retirees still need money to live. If you convert aggressively while also spending heavily, income spikes, healthcare subsidies vanish, taxes rise, cash flow becomes tight. The strategy we're discussing is simpler. You're not converting money. You're using it. You're turning pre-tax money into lifestyle income at controlled tax rates while preserving flexibility. And for the right retiree, this can outperform heavy Roth conversion strategies during early retirement years. Now, quick pause here. If this kind of thinking is helpful for you and you want more clear, calm retirement strategies like this, take a moment to like this video and subscribe to the channel. It helps more retirees find information that actually protects their future. Let's also talk about something people don't like to think about, but must. The survivor problem. When one spouse passes away, the surviving spouse often moves into higher tax brackets. Same assets, same income sources, much worse tax treatment. By reducing pre-tax balances early, couples can dramatically soften this blow. It's not just about minimizing taxes today. It's about protecting the person you leave behind. Now, this strategy is not for everyone, and that's important to say clearly. It tends to work best for retirees who have three things. First, a meaningful amount of pre-tax savings, often $1 million or more. Second, taxable savings with a relatively high cost basis. And third, a period of retirement before Medicare where income can be controlled. If that sounds like you, this approach deserves serious consideration. If it doesn't, that's okay. Retirement planning is not one size fits all. But blindly following generic withdrawal rules can be costly. The real lesson here isn't always withdraw from your 401k first. The lesson is this: early retirement years are precious. They are flexible, and they should be used strategically, not wasted. Because once Social Security starts, once Medicare rules apply, once required distributions begin, your options shrink, and taxes become reactive instead of proactive. One last thing that rarely gets mentioned. Money earlier in retirement is more valuable than money later. Not just financially, but emotionally. At 60 or 65, you travel differently. You move differently. You live differently. Optimizing every dollar for age 85 while ignoring age 65 is often a mistake. A good retirement plan respects both math and life. Before we close, here's your second reminder. If you want retirement strategies explained simply, honestly, and without hype, subscribe to Life After 60. This channel is about protecting peace, not selling fear. Retirement shouldn't feel like a tax trap. With the right withdrawal strategy, it doesn't have to. And sometimes, doing the opposite of what everyone repeats is exactly what saves your future.